Welcome back to Trading 360. It's been a tough year for consumer staples, and so the sector now looks ahead to 2024, though just recently, I mean, November has pretty much seen up arrows for pretty much every sector with the exception of energy. But what does it mean for this group? Some concerns about margins or headwinds. Alexis Browne's with us, COO Portfolio Manager, Alexis Investment Partners, and Mel Casey, Senior Portfolio Manager, FBB Capital Partners. I'll start with you, Alexis. Do you like the group, and what will drive this in the next few months?
Well, hi, Nicole. Thanks so much for having me on. Happy Thanksgiving, belated. Personally, we are not a huge fan of consumer staples. Like you said, they've been laggards this year, and our main thesis around consumer staples is that they were a beneficiary of that TINA period when there was no alternative due to zero interest rates. And so when people were looking to get more defensive, rather than going and getting nothing on bonds, they were trying to get more defensive using stocks, and often turns to things like consumer staples. However, as interest rates have risen dramatically, that's kind of been unwound. And while most of that may be behind us, a lot of the biggest consumer staple names, think your Costco, your Coke, your Pepsi, are left looking pretty richly valued. And so while we are constructive on the market in general, and even on some consumer names, particularly in discretionary, consumer staples just isn't where we're at.
Right, and you do have a few names that you do like. You note the valuation, and that has been part of the concern, Mel, right? I mean, the thought is that maybe some of these are too frothy, overpriced, particularly when now they're not going to have the pricing power any longer.
Sure. Thank you for having me on, and happy Thanksgiving. I think valuation is always important to look at. If you look at the performance of the sector this year, it has been one of the underperformers, but that's relative to having been one of the stronger performers in 2022 when we began this kind of dramatic rate cycle. So it's done a lot better as investors get more comfortable that we're out of the woods on this rate hiking cycle. So the defensiveness has definitely been an attractive characteristic. The valuation is an important thing to look at. I think if you look at some of the stories that are happening within the sector, the valuation is kind of corrected for some of these. So looking at Pepsi, which we've talked about before, it's generally traded at a premium to the group. That premium has been warranted based on a long-term beat and raise history. But with recent investor concerns over obesity drugs, that's taken that valuation premium away. And we think that's a pretty good entry point, especially since there's been no change in terms of that trajectory of beating and raising.
So at this point now, there seems to be some apprehension on the group, even during a time where stocks are at 4-month highs. Alexis, you talked about some aggressive buying that you did when the market pulled back. But you do like some names, and staples is really not what you love, but you do like TJ Maxx, Marriott, even part of maybe the ETFs. Is that the way to do this? Tell me what you would buy or recommend to folks.
Mel made some really interesting points as well here, but you're right. We did some aggressive buying in this latest pullback, and so far we've been rewarded for that. We did not go into consumer staples. However, we did buy a position in TJ Maxx. We like TJ Maxx. We've held Marriott for a while. The consumer does seem to be very resilient, even given all of the headwinds that we've been talking about for months now. And we did buy into just more of the broader ETFs. We have RSP, DIA, and that's where we have our consumer staple exposure, rather than having it in any individual basis. We do run a tactical ETF, and so in that we're used to looking for these trends. And as we look forward into this coming season, where it does tend to be very strong going into the holiday season, especially for consumer discretionary names and more of those growth plays, and then into the early part of next year, we continue to remain constructive on this market. And right now, we're not looking to unwind our overweight equity exposure. But when we do, we'll most likely be looking into bonds and most likely treasury bills rather than, say, consumer staples. And we will, as always, remain flexible on that and open to changing our stance. But at least for the next few months, given, again, strong seasonal patterns and trends and relative valuations, we don't see that changing.
Right, okay. Yeah. All right, unfortunately, we're out of time. It's a shortened trading day. Very appreciative that you were both here today, Alexis Browne and Mel Casey. Thank you both for being here.